Hello and welcome to this latest installment of Courses on Demand, which have been brought to you by Forex.Academy. So this particular course is all about trading trending markets. So just before I explain exactly what we'll cover for the remainder of this course, can I ask you please first to take note of our risk warning. It's incumbent upon us to make sure that you are fully aware of the risks involved in trading financial markets, and please do be aware of those risks at all times. So if you do need to stop this recording and take note of a risk warning, then you are very welcome to do so. Okay, so let's start with an outline of this webinar. So we pride ourselves on actually looking to blend theory with practice, and we'll do this throughout. Plus, we'll have a significant period at the end for a practical application of this particular topic. So we'll start in terms of looking at the basic theory behind trends by defining what a trend is. We'll have a look at the characteristics of trends. We'll look at the differences between directional bias and non-personal, and excuse me, it's more of a statement, not personal bias. And it's just important you as a trader differentiate between the two. Then we shall look at, well, how does technical analysis fit in to this in the overall picture? We'll have a look at a trader's ability to observe a trend and obviously be able to identify one. Then we'll have a look at momentum and the trend and the impact that momentum can have. Then we'll move on to trending phases, and we'll look at the very popular saying within trading circles, which is that the trend is your friend. So we'll have a look at that in some detail. We'll have a look at trends in different time frames and some of the information we can glean from that. The importance of multi-time frame analysis when it comes to identifying trends. We will finish the theoretical part of this course by looking at trend reversals. And then we'll get quite practical. So we'll go into some live charts and we'll look at trading trending markets, the practical or the practice side of this particular course. And we'll also look at commonly used trend indicators and look to give you a brief overview in terms of the application of those indicators in a live environment. Okay, so we've got quite a lot to get through in this particular course, so we do hope you enjoy it. So let's start with a trend definition. So in short, it's simply a general direction in which a market is developing. So it is commonly known that if you trade in the direction of a strong trend, then risk exposure can be reduced and potential profits increased. So that is I guess the beauty of looking to become, or to at least be proficient when it comes to identifying trends, because the opportunities it gives you are really profoundly quite important. And any trading system or style which has the potential to reduce risk exposure and be able to give you some very, very interesting opportunities for increased profit, then it is definitely worth considering. So there's two types of trends. There's an uptrend, and this is simply a market that is developing to the upside, i.e. prices moving higher and consistently higher. Now, an uptrend is also known as a bull market. It's probably something that you have come across before, or it's also, you might have heard the term, the longs are in control of the market, so you can either go long or you can go short. So when traders go long, it means they're looking for prices to increase. If you are trading an uptrend, then it's commonly known as a bull market. And a very well-known image in New York of the bull market, as you can see currently on screen now. Now, the other type of a trend is the opposite of an uptrend, and that's a downtrend. So this is a market that is developing to the downside this time. So i.e. prices are simply moving lower. And this is also known as a bear market. Our shorts are perhaps in control of that particular market, looking to drive prices lower. Okay, so just to explain in a little bit more detail in terms of why the terms bulls and bears are used in the first place. And in actual fact, it all derives from nature in itself. So if we look at the aggressive approach of a bull when they're attacking their prey, what you'll find is they look to dip their head and look to drive their prey to the upside. So that is the essence of a bull and the way that they attack their prey. Now, in addition to a bull, a bear in nature will be looking to attack their prey by standing up really tall and looking to beat down their prey. So this is the reason why bulls are bears, and that terminology is used in the financial markets, meaning if you're a bull, you're looking to drive prices to the upside. However, if you are a bear, you're looking to stand up, figuratively speaking, nice and tall, and looking to drive those prices to the downside. So hopefully this image will assist in that understanding. Okay, so moving on then to the characteristics of a trend. So there is some significant and very important characteristics of a trend. And the first one is to just identify and perhaps touch upon an uptrend. So when we talk about an uptrend, it is simply a series of higher highs and higher lows. So let's look at this chart on the right-hand side. As you can see, it's moving from bottom left to top right. So we know that we can visually see that this market is moving to the upside. However, if we want to be able to identify it as a trend, we'll need to identify that this market actually is achieving a series of higher highs. So HH just stands for higher high. And as you can see, I've just documented them there on this particular chart. You can see as the price is moving to the upside, so is the series of higher highs. And that qualifies, that is one part of qualifying this particular market as being in an uptrend. Now, what also would need to go hand in hand with this is the fact that this market will keep printing a series of higher lows as well, signified by HL up on screen now. And as you can see, all of those higher lows are increasing in price. So what that means is we are clearly, and in terms of characteristics, we're able to identify that this is a clear uptrend, and we're seeing those prices continually to push higher. Now, at the same time, and it's the same principle, just literally upside down, a downtrend is a series of lower highs and lower lows. So now we're going to look at this particular chart, and we can straight away identify that prices are moving from top left-hand corner to the bottom right-hand corner. However, this time, what we would need to see is a series of lower highs. So as the market is moving lower, it prints lower highs as this market is moving to the downside, and it does so on many occasions. So that qualifies our understanding and qualifies the characteristics of this market as being in a downtrend. But what it will also need to do is to print a series of lower lows signified by LL. And as this market moves lower, you will continue to see these lower lows being printed. So if you are in this market, you can clearly identify prices are moving to the downside. And if you are in this market and you're deciding to get into this trade very early on, and you keep seeing a market that's producing lower highs and lower lows, then you kind of want to give that trade as much room as possible to capture this move for as long as you possibly can. And all of these are very much relevant to a whole variety of different time frames, which is one aspect of trending markets that we'll look at in some detail very shortly. Okay, so that's the differences between an uptrend and a downtrend. Also, an increase, what you're likely to see is an increase in candlestick volume. And this is increased volume in terms of the price movements of these markets. So what you're very likely to see in a downtrend is a larger number of increased or size candlesticks in terms of the price and the range. So we'll be looking to see increased volume in this market as this market is moving in the direction of the trend. So all of these slightly larger red candlesticks would would actually show you visually the increase in candlestick volume to the downside in order to get those price moves, that price moving lower. So another characteristics is actually with regarding to price action would need to have a clearly defined direction, of course. So what you're seeing is currently up on screen is a clearly defined price action continuing to print a series of lower highs and lower lows, and it is moving in one clearly defined direction, which is to the downside. Okay, so those are the characteristics of a trend. So moving on to directional bias, and we will be making the point that directional bias is actually not personal bias. They are different, and they need to be treated differently as well. So what we are seeing up on screen is when traders trade the CFD markets, they make the decision to become a buyer or a seller. However, due diligence should be carried out prior to making this decision. Otherwise, you will effectively have absolutely no idea as to why you are entering a particular trade. So this practice should obviously be discouraged. However, at even a basic level, incorporating trend identification and directional bias, you will stack the odds in your favor quite considerably and look to increase the probability of a successful outcome. So this is what all traders look to do and achieve. However, it must be pointed out that directional bias based on technical analysis is not to be confused with traders having a personal or an emotional bias for any particular market. So for example, you often hear a trader say, you know, I believe this market is going to go up, or I believe this market is going to go down. So if that's the case, if you have a particular belief that something is going to happen, then or you have this emotional bias that you just have an innate sort of feeling that this market is going to continue to push higher, then that is a very, very dangerous position to be in. So for us, it is important to keep these somewhat separate. You know, trade what you see and not what you necessarily think will happen or what you believe may happen. So, and I suppose that is some of the profound benefits that technical analysts have within this market, because we do have the ability to look at a price chart and make these decisions from a very objective perspective. Okay, so hopefully that makes some sense. So sticking with directional bias and just looking at a very, very brief example. So James, a particular trader, can see that an equity index is currently in a bull market, meaning prices moving to the upside. So because of this, he then decides to become a buyer. So now he has a directional bias. So James now has this directional bias. He is now looking for opportunities in a particular market to get in. But where does he start? So luckily, James has a particularly significant understanding of technical analysis. And what he's able to do is to draw trend lines on his chart. He'll be able to see that the price is close to pulling back to his lower trend line. So he plans to enter at a specific price close to the lower trend line. So I'll explain this. I'll look at a chart very, very shortly. And I'll explain this in a little bit more detail in terms of how James can actually use his skill and his basic understanding of having a directional bias, being able to apply very, very simple and easy to apply trend lines on a particular chart, and it will enable him to make some fairly solid decisions in that particular marketplace. So just before I look at that chart, I do want to touch upon how does technical analysis fit in. So technical analysis is built on the assumption that prices trend in one direction or another eventually. And I suppose it is important to highlight the word eventually. The reason being, we have a price cycle, and we'll discuss this in the charts very, very shortly, but they go through different phases. Now, if a market is not in a phase of trending, it's in a phase of consolidation, i.e. moving sideways. So there's no clearly defined characteristics of a trend either to the upside or to the downside. However, when you do get these periods of consolidation, you often get trends born off the back of that period of consolidation. So that's why we've used the word eventually in there. So trend lines can become an important tool to technical analysis for both trend identification and trend confirmation. So a trend line is simply a straight line that can connect several historical price points which can extend into the future. So these trend lines can then act to assist in the direction, in the decision making of future trade ideas. So this is the chart I was referring to, and James can do his technical analysis. He can apply his trend lines on this particular chart, and we can see that it's in an uptrend. We can see that this price is very, very clearly moving to the upside. Now, that's quite important because when he projects his trend lines looking to push these prices higher, as you can see, we're getting this lovely move to the upside. He's looking at this price action in here, and he can identify just with basic technical analysis that actually if he looks to enter at this lower trend line, then he's very likely to get a positive outcome on this trade. The reason why he can make that decision with a certain degree of comfort in that particular decision-making market, because when he does his analysis, he can see that this market has behaved similarly on many other occasions, with some positive outcomes in these trades, and you can see that this potential, especially in the more recent trades in this uptrend, have been slightly more profitable than perhaps one of these earlier ones. However, if you adopted an approach, and we look at the approach to risk management as well very shortly, if you just kept your stop loss outside of this trend line, you would still be in these trades from even these lower prices, if this fits in with your approach to trading these markets. So this is what James has identified. He can clearly identify that we are in an uptrend. So now he's looking for price to act and behave in and around the lower trend line, and he identifies this particular candlestick in here, which has just bounced off that line, and he identifies that as a premium opportunity to start taking this market to the upside. So that is how fundamentally technical analysis fits into this basic principle. It allows a trader to be able to make informed, very educated decisions on a trending market. Okay, so moving along fairly swiftly, I suppose it must be made clear, and something that most traders do have issues with is determining or certainly validating a particular trend. And it is important to point out that the more times a trend is validated, the more significant the trend becomes. So in these early moments down here, you can see that the market is, not so explosive to the upside. I'm suggesting you could do a little bit more analysis on this market and identify some very key areas. But as you can see, the market will give you plenty more opportunities to get in, and the more times the trend is validated, and every touch off the bottom trend line is counted as a validation, and also off the top line as well. And you can see that it's validated to the upside, and there is traders out there that look to sell these highs and not just buy the lows, but to sell the highs to varying degrees. The success, the actual likelihood of a positive outcome slightly decrease over and above the potential for the buys in an uptrend. So that's what you should be looking for if you're looking for fairly trades with a higher propensity for a positive outcome, let's say. Okay, so that's important to know, that the more times a trend is validated, the more significant the trend can become. Okay, so moving on with trend observation and our ability to identify these trends. So in which direction is the trend? So it's quite easy to be able to put everything together, especially historically, and determine, and I look at a particular chart and see if you can identify a series of highs and a series, of higher lows, and a series also of higher highs. As you can see that this market is performing in a way which suggests that we are in an uptrend. So that's putting all the characteristics of an uptrend. So what we're seeing is what's referred to as very, very bullish price action. So the market is in a bull run to the upside, and we're getting the directional bias is very much to the upside, and therein lies our bullish trend is therefore confirmed. So hopefully you'll start being able to build the potential to look to navigate a market like this once we're in a bull trend, and look to stack those odds in your favor when you do trade these markets. Okay, so sticking with the same theme, however, we're going to ask a slightly different question. In which direction is this particular trend? So what we're identifying now is a series of lower highs as the market moves lower, and a series of lower lows, as we're just putting it onto the screen right now. So really we're able to go through that same process as an uptrend. We're able to identify that we can clearly see bearish price action in this market, and of course that means that this market is moving to the downside. So very clearly defined, very easy to identify, and therefore your bearish trend is confirmed. So we're getting a series of price movements continuing to move to the downside. Now, I'm sure you'll ask, why is this particularly important? It's important because if you decide to go with these trends, you have a greater likelihood for success when you trade these markets. However, it's not conducive to every trader's personality. It might require a significant amount of patience. If you are a trend trader, you have to put up with what are called pullbacks or secondary trends, which we'll talk about very, very shortly. So there's pros and cons to every particular style to trading these markets. But that's what you want to take out of this market, is to just simply know that if you are looking at this price action on the bottom right-hand corner of this particular chart, what you need to acknowledge is that actually this market is technically in a bearish trend, and therefore you as a trader can make the decisions accordingly. Okay, so again, sticking with trend observation and our ability to identify trends, we want to ask the question, can it become difficult to identify a trend? Absolutely, depending on the price action. So we can look at this particular chart and we can clearly see that actually over a significant period of time, we are starting at the bottom left and we are more recently pushing top right. However, it's not always really, really clean cut. So what you're finding is significant moves higher followed by significant moves lower, and even sort of some of these markets making lower lows, which puts a question mark in the head of someone that is looking to trade trend. So of course it can become quite difficult, quite challenging at times to be able to make that very, very clear-cut decision. And as you can see, this market has made a series of lower lows, even though the overall price action does continue to squeeze higher. So this market can have some of the characteristics of a trending market, but in practice can be very, very difficult to be able to identify with any degree of certainty. So of course, you know, all these types of approaches there's positive and negative aspects to all of these types of approaches. Okay, so and I suppose it's very important to take on board as well that the markets can become very, very volatile and don't necessarily trade in a linear fashion. So that's absolutely the case. You could get some trending markets which are very easy to identify, and you can observe them historically as well, and they perform very, very nicely, and all they do is likely to stack the odds in your favor if you do decide to get in and trade with the market behind you. However, you must also be aware that you know, these markets can become very, very volatile, where your ability to identify that trend can be a little bit disruptive. So please do bear that in mind. Okay, so moving on to momentum and the impact that that can have on the trend. You know, can we, looking at this chart up on screen, and just bear in mind that what you're seeing on screen is price action over a 7-month period. And we just identified a particular date at the end of this chart. So we want to ask ourselves a question: can we find clues by observing historical price action? So we can look at this chart and we can identify that actually at point number 1, we've seen this market gap to the upside, which in itself is a very, very bullish move in itself. We can also see very recently that the market tried to close that particular gap. However, we had buyers entering this market, creating an engulfing candlestick structure, which just simply engulfs the candlesticks that came before it, driving prices fairly significantly to the upside, blowing these sellers out of the water, and the price continues to move to the upside. So can we find clues by observing historical price action? Of course we can. That's not it. There is other, and there's a number of other different types of clues that we can begin to find. And this really works hand in hand with momentum. Are we seeing continued momentum in this chart? So what we're looking for is bullish volume, meaning we're getting nice, explosive, extended moves to the upside with a significant range in these markets. So you get a nice green candlestick being pushed higher, and you can see these candlesticks have, you know, you can see a few of them on this particular chart, and you can certainly see more of them as well, which is the reason why this market is moving from bottom left to top right. So this market, just looking at historical price action, we're moving in a very linear fashion from the left-hand side to the top right, and it brings us in to the 3rd of October in this particular chart. So let's say we have our trader James trading this particular market. Let's ask ourselves these particular questions. You know, has a trend developed? We can quite clearly see that in actual fact the answer to that particular question is yes. The trend has developed. Is there momentum behind the particular move? Yes, we can see quite a number of significant bullish candlesticks in this market, so we can confirm that there is momentum behind the move. Can we apply technical analysis to this particular market? And is the trend likely to continue? So this is where all of that comes into play. The technical analysis, so we can identify those characteristics which give us very, very early indication. We can put in technical analysis, which is genuine levels of support resistance into this chart. And you can see how the price begins to behave around the 3rd of October up here. And because we don't get markets moving in a linear fashion, in a straight line, what we get often is we get a pulse to the upside, followed by a little bit of consolidation, followed by an additional pulse, followed by significant consolidation, and then a bit of a pulse move to the upside once more. So that's not all. What we can see as well is that it can then start to produce some significant opportunities to push these markets to the upside. So you could be looking at this range-bound market, and if you're a range-bound trader looking to buy off levels of support, this level, which coincides with previous levels of resistance. So what becomes resistance on the way up becomes support on the way down. So if we have range-bound traders that would look for opportunities around this, just above this level of support, just in here, would get an opportunity to take this market higher. We also have another trend line just above it. So if we have our breakout traders around this kind of level, seeing this price action, they'd be anxious to push this market to the upside. And also you get your pullback traders as well. So you're getting the explosive move, you're getting the pullback, and they're looking to buy that particular pullback and see if this market squeezes higher. So so you absolutely can look for opportunities by looking at historical price action, looking at what is currently happening, using technical analysis to enable you to get into this particular trend. There's our extended trend line, so you can have a bit of comfort that, you know, prices in this market are being supported, and we're seeing that little price increase there on the top right hand corner since the 3rd of October, with the ability to get into maybe 2 or 3 trades over that period. And this just happens to be a daily time frame, so the same applies to much smaller time frames. You still potentially get those opportunities and being able to build a particular picture for you to execute trades accordingly. Okay, and this is just so happens to be over the remaining 3 or 4 months of this market. Okay, so there is opportunities to look at, and momentum is a very important, plays a very important role in that decision-making process. So moving on to the different phases that you will see and experience within a trend. Now, it's important to note that while the markets can trend in a general direction, it must also be noted that this does not happen in a linear straight line fashion. So as we've alluded to, that's not what trading is all about. Now, we can see here that as price action, which is represented in this fairly easy to identify blue straight line, we can see that the market makes what's called a trend high. So that's when the market is pushing to the upside and we make a high in this market. That particular high can give opportunities for sellers to get into this market to start driving this trade to the downside. Then what is created is a corrective low. This is when, so we start moving from resistance, meaning it gives opportunities to sellers to take this market to the downside. And at a certain price point, we start running into buyers, which can be supported by this green ascending line currently on screen, which can take the role of or lower trend line, where prices become very supportive at these lower levels, and we're getting an explosive move to the upside, breaking the previous trend line, making a new trend high in this market. So it's just another way of saying higher highs and higher lows as this market is moving in our favor. And what's created at this new trend high is some resistance, and we're getting sellers looking to drive this price to the downside and creating a corrective low, or a higher low, as it's also called. So this is a low and this would be a higher low. This level in here would be a high, and this level would be a higher high. So just to clarify, because I appreciate we are using different terminology, but we're making trend highs and then this market is creating corrective lows. So that gives opportunities for buyers to enter at these levels of support and look to drive that price higher, and of course beginning to make a new higher high in this market. So this is the technical sort of overview of this market. What I'm going to do is take these away and just highlight the difference of these phases. So what you can have is your primary trend phase. So that very simply is the part of this trade which is driving prices to the upside. So as you can identify by these three levels. So this is your primary trend phase, and very, very easy to identify. You're getting these price moves continuing to move to the upside on a regular basis. Now, this can present some fantastic opportunities for traders. However, that is, in terms of a phase, that is your primary trend phase. Now, there is also secondary trends. Now, these are referred to as the pullback phases of this particular market. So when a market is pushing higher, it's in a primary trend phase. And when it's actually reversing and some sellers are entering this bull market, then this is referred to as the secondary trend. Okay, so we do hope that that is fairly easy to understand. Now, this is a diagram that's bespoke. So what I would like to do now is to take that understanding and just go and have a look into some live charts, and we get up our trading platform. So this is what our trading screen looks like and what we can identify in here. And I shall, sorry, just bear with me just a moment. What I shall do is I'll use a nice solid green to just identify moments in this chart where we're getting clearly defined primary trend. And you can see there's lots of opportunity or potential opportunities, should we say, in this market for this price to be moving lower. So the green lines are obviously our primary trend, and I'll get a nice solid red to just identify or to show you as easy as possible some of the secondary trend moves in this market. Now, as you can see, they vary. This is a clearly defined downtrend, i.e. pushing prices lower. So that's what we're seeing in this particular market. And the point that I would like to make is that our primary trend is pushing prices lower, and our secondary trend is pushing prices higher. So bearing that in mind, I'm just going to put a big P in there. So the green line just constitutes prices pushing lower, and the red lines just constitute opportunities for buyers to start buying the secondary trend. And it's just really you as a trader knowing what you're doing is really the point we would like to make. If you are a trader that looks to capitalize on primary trends, then you can get some significant opportunities on many occasions depending on your approach. Maybe you're looking for the pullback and you can capture those approach. Maybe you're looking for the breakout trade. So whatever the case may be, whatever your approach is, some will be profitable trades, some are very likely not to be profitable trades. However, if you are going with the trend, i.e. making sure that this price action is moving to the downside, then you've got a higher chance for success, especially if you're new and relatively inexperienced to trading these markets. Okay, so that's just a practical look there at the charts. So you'll often hear the phrase, the trend is your friend. Now, that is quite true and very, very accurate for a number of reasons. So the reason why this phrase is used so often is due to increased likelihood for a positive outcome through the ability to accurately reduce risk, but also increase profit potential. However, there's a few points to remember, and they're points that we've discussed already. The more times a trend is validated, the more significant that trend becomes. What you often find is those that are more experienced get into those trades perhaps earlier than those that take a considerable amount of time to validate, identify, and then see those trends and then act accordingly. So And this all goes down to the amount of experience you have within these particular markets. So certainly those that get into the top of trends would be more so new and fairly inexperienced traders, whereas your more experienced traders are very likely to get into those trends at the early stages, or perhaps in the medium phase of those trends. So please do bear that in mind. Also, another point to remember is that identifying trend support and resistance and effective risk management is absolutely key to successful trend trading. So identifying these entries is not the end and be all. It's your ability to effectively manage risk in that situation is worth considering. Now, the final point to make is that without doubt, the trend is your friend. It's very likely to result in a positive outcome. It's not impossible for those trades to take a series of losing trades when you're trend trading. Of course, that's the case. Now, the trend absolutely is your friend until it reverses, and being able to identify a reversing trend is actually very, very important, and that is what we'll be discussing very, very shortly. So before we do, we're just going to look at trending markets in different time frames. So trends can often take time to mature. Technical traders can therefore apply trend analysis to shorter time periods to attempt to identify trends at an earlier stage. So depending on the style of the trader, profit can very much be made by observing price action and identifying trends over many different time frames. So this is when we're talking about multi-time frame analysis. So to explain this in a lot more detail, I'd like to do so by just sharing these charts with you. So this happens to be over a 3-day period. However, this happens to be a daily time frame. The middle chart happens to be a 4-hour time frame. However, on the right-hand side, we can clearly see that this market is a 1-hour chart. However, all of these markets are over a 3-day period. So we're beginning to be able to identify and see different, we're able to see price action across different time frames. Now, when I suppose one of the issues for a trader is for them to be able to identify the best trading opportunities. So from a trading frequency perspective, if we go the further down the time frames we go, so you might struggle if we're looking at a daily time frame just off these 3 candlesticks. You may have had an opportunity if you were able to get into this market above the daily high, the second daily high, or something of that nature, but you're limited with information, so you may not sort of find a potential opportunity on the daily time frame because we've got such little information to work with. However, on a 4-hour chart, we can see the price pulse to the upside, a little pullback. We get to see our little spinning top candlestick in there, and we then start to see a little bit more momentum coming into the upside. So for those traders that perhaps look at breakout trades, it could identify an opportunity to take this market to the upside around that kind of level. But again, the frequency of trades, because you're working within a 4-hour time frame, you might get one opportunity within this particular price action. So moving on then to our 1-hour chart, what you're finding is you might actually be able to identify a series now of potential opportunities. So our pullback or our breakout trader might identify this particular candlestick to take this market to the upside. And we also have a bit of a pullback trader coming in here and looking to take this market to the upside on that occasion as well. So potentially in a 4-hour chart, we potentially have an opportunity to take this trade, whether it's the pullback trade looking at this candlestick or whether it's the breakout trade above that. You're very likely to probably take one of those trades, whereas in an hourly time frame, you might have the potential to potentially take at least 2 trades within that same time period. So in terms of the best trading opportunities, that is a slightly different question. What we can actually identify is the lower the time frame, the more opportunity you'll get. It doesn't necessarily mean that it will be the best trading opportunity. In actual fact, you know, the larger the time frames, the more time you have to think and to act accordingly. The smaller the time frames, the more rushed you will be in terms of your decision-making processes, and therein lies some of the difficulties for those learning how to trade profitably. So different time frames offer different opportunities that must be stressed and pointed out. The lower the time frame, often the greater the opportunities in terms of number, but also the greater the risk. So there is pros and cons with this as an approach. Okay, so but then you can quite clearly see, just looking at these 3 time frames, that each one reinforces the other, and the fact that opportunity cost needs to be considered within a trader's approach to trading these markets. So sticking with the importance of multi-time frame analysis, there's a number of reasons that we've identified that make multi-time frame analysis actually quite important. And also from a trending perspective, is that you know, what you're able to do is to see more clearly what is happening to price and who is genuinely in control of that particular market. So our buyers, are we in a bull trend and prices are pushing higher and therefore buyers are in control of that market, or are we in a downtrend and in a bearish market where sellers are clearly in control of that market? And looking at different time frames can enable you to make that decision a little bit clearer. The larger the time frame, the more important things like genuine levels of support and resistance can actually become. It can show traders where the market is very likely to move towards as well. So that's worth taking on board. And it can assist with the early identification of trending phase, whether that happens to be the primary trend or the secondary trend as well. So looking at those smaller time frames to increase the potential for opportunity. However, looking at much larger time frames to clearly get a comprehensive view in terms of the trend and the direction of that trend and who's in control of that trend, and how that trend is unfolding as well, can also prove very, very important for traders. Okay, so moving on then to trend reversal. So to spot a reversal, a trend reversal, firstly, we need to be able to identify the trend and the direction of that trend. So, and the reason why we make that statement is because of the nature of a lot of traders, especially when they're new and starting out, even struggle to identify that we're actually currently experiencing a trend reversal. So to identify a trend reversal, you need to be able to identify the actual trend in itself to begin with, and obviously know what direction that trend is effectively moving within. So then we need to be able to identify that something technically significant has changed within the underlying price structure. So it's that significant change which is actually quite important to us, and gives traders some significant knowledge about what is likely to happen next. Now, there are many indicators which can assist with trend reversals. However, in basic terms, a simple visual break of the trend line with conviction, volume, and strength often signifies a trend reversal. So let me give you hopefully a fairly clear-cut example of this. So what we're seeing is, we can quite clearly see we've got a clearly defined uptrend in this market, giving opportunities for traders to trade this market on multiple occasions, some more successful than others. However, you can see the nature of these moves and the potential for some winning trades. Now it's important to note and to just qualify what we're seeing here. We're seeing the market bounce to the upside, but look where this market come back to. It's still sort of wants to hug and come back to this trending line at the top of this trend, and you can see it even pushes higher before it starts to come back beneath the upper trend line, as you can currently see on screen. So when we see price action like this, we ask ourselves, is this trend line potentially still intact? The answer for us is yes, it is. It's very messy. It's not really what you'd want to see. However, the trend line and the integrity of that trend line is, for the time being, still intact. So then we could look at opportunities like this to potentially look to take this market lower, which is what we see. You might get your buyers looking back historically and thinking this market is going to continue to push in that direction, and would be very happy for a certain period until the market comes back to the lower trend line once more. So taking all of this off, I would like to sort of draw your attention to the price action that's going on inside this circle. So again, there would have been many traders that get into this market, perhaps looking to buy above that level, with the expectation for this market to continue within the trend line. And that would be a perfectly reasonable decision to make. Now, those traders would have taken a loss in this particular trade. However, would they have identified that there's a clearly defined trend to the upside in this market as signified by this green line? So really, those traders that look to buy at this lower trend line is absolutely within their rights to do so. If they've adopted that approach and many times before, they would have been given many successful trades in this market. However, something has significantly changed. And I just want to draw your attention to the price action as it's pushing higher. It then gaps down and the market starts to push lower beneath the lower trend line. So straight away, those traders that were looking to buy at this candlestick are now, well, hopefully they've used stop losses. So those traders are now out of that trend. And the question that we would want to ask ourselves as traders, has something significantly changed in this market? And the answer overwhelmingly is yes. So we've gapped down. So that's the first dangerous signal. Now the market sort of consolidated sideways for a bit, broke lower and then pulled back to the upper trend line. So that's how these trend lines work. They act as magnets to the upside and to the downside. And so price action pulled back to that before we got the flush to the downside, and we got considerable momentum and volume within this market. And you can see the number of red candlesticks in this market are plentiful. So something has significantly changed at this price point, and we can see it, and we can see it supported by our technical understanding of what's happening in this market. So at this point, you would be within every, it'd be a perfectly reasonable decision to say at this point to look for opportunities to actually sell that point. If you're taking all of this technical analysis on board and you're understanding how these markets behave, and identifying when something structural has changed in this market. So this is actually a good example, and then you can see the downward move that has occurred once we've analyzed what's going on inside this space. Okay, so that is the basic principle behind the trend reversal. Now, like we said, there's lots of indicators that can give you that information. Certainly, if you are a technical trader, you can certainly see, you can just do some very basic technical analysis, and you can be able to see it in very real time and be able to make decisions, hopefully accordingly. Okay, so that's trend reversal. So now let's just have a look. This is the part of this particular course where we can practically apply some of the topics that we've discussed in this course. So what we'll start by doing is looking at an easy technique to identify trending markets. And we shall also look at different phases of a price cycle. So to do this, we will call up our trading chart. So I'll bring this up onto screen just right now, and we'll move this along, and we can start to have a look at the pound dollar chart. So the first thing to do is, what can we do to identify a trend? If we look for an easy tool, let's say an easy technique to identify trading opportunities first. So let's do that. So what we can do is we can use these tools within our MetaTrader 4 platform, which will enable us to do that. And we don't need to spend that much time, but we can clearly identify potentially a lower trend line, pushing prices higher and supporting prices at those levels. And we could probably work with an upper trend line as well. So we can clearly identify that price action is clearly moving in one direction, and we are moving to the upside. Now we can see all the opportunities for the secondary trend. We can clearly see and identify all of those traders that look to sell the primary trend. So we can see that the market is moving to the upside, but it doesn't stop those types of traders making decisions to look to sell these markets. And we can also clearly be able to see our primary trend traders looking to push prices higher, and they get many opportunities to do so. And as you can see, the price moves are often fairly significant. And those opportunities could be significant, obviously, depending on your approach to risk management. So we can very easily be able to look at any particular chart, be able to apply technical analysis in a very coherent manner. If we were breakout traders or pullback traders, we could identify multiple opportunities in this chart. And let's work with slightly lighter blue, and these just identify genuine levels of support and resistance in this market. And how we identify those is just looking for market highs and lows. It's not overly necessary to be too specific about it, and you can see then how price even behaves on multiple occasions by either bouncing off those levels and acting as support and resistance, or with the actual breakthrough of those levels clearly defined. What's important to take note of is confirmation, because you can use these levels in a variety of different ways. So you can clearly apply very simple, easy to identify tools in this particular chart to be able to assist you with not only trend identification, but also with entries and exits, and we'll have a look at this very shortly as well. So another market to look at. This just happens to be the euro dollar. So we can have a bottom trend line, again presenting many opportunities to start squeezing prices to the upside. And if you'd adopted that approach, you would have had many successful traders to trade in this market to the upside. And again, it's just it's a fairly relatively easy approach to be able to look at sort of major levels in this market and applying support and resistance to this market to assist you with not only trend analysis, but also your potential to get in and out of these markets. Now we will be producing our own course on demand about support and resistance. And but what we're doing and what it can do is it can assist. It's a very, very easy to use approach that can assist with trend analysis and can really help you with your ability to navigate these financial markets. And again, this principle can be applied to a whole variety of different markets and a whole variety of different ways. Now, when we talk about price, a price cycle or different phases of a price cycle, again, sort of very, very basic tools can be used to identify the phases of a particular market. And to show these very, very simply, it's very, very easy to understand that the phase of this particular market between those two levels is a trending market to the upside. Very, very easy to see. We had a bit of a pullback in this market, but look, when we use technical analysis, we can clearly see and identify. So this phase is without a doubt a bullish phase where we're seeing prices trending to the upside. We get a bit of a pullback, and then this market starts entering another phase. And that's when we start becoming significantly range bound in this market. So we're getting prices working within these lows and highs on a fairly consistent basis. So when we see price action like that, we're entering a new price cycle. And that means that this market is consolidating and it's going to move sideways. Now, there's traders that are range bound traders that would look to sell the highs and buy the lows. Of course, that's obviously viable trades. Of course it is. There will be other types of traders that will be looking to capitalize on the breakout of this market, either to the upside or to the downside if they get that opportunity. So as you can see, the more recent price action allows potentially breakout traders to look to sell this market to the downside. They may have done so at this point here, expecting this market to squeeze lower. At that point, that would have been a losing trade. But as you can see, this one here would have been a winning trade. So it is important to know that actually quite often, when a market moves from one phase, which is a trending phase, we can often get a period of consolidation followed by, once that consolidation has been adequately overseen, the market can gather pace and we can start entering a new price phase, potentially where we get quite an explosive move back to the downside. In actual fact, that phase, for all intents and purposes, would have actually started much higher. So we can just continually go through phases. We can go through trending phases where prices are pushing higher. We can go through sideways moving phases where markets are simply moving sideways. And we can also go through trending phases to the downside as well. And if we apply that logic, you can look at any particular chart. So we look at one more, and you can apply that particular logic across the board. So what we can see in this chart is we had a fairly consistent sort of trending phase in this market, pushing prices to the upside, followed by, I must admit, a fairly aggressive trending phase to the downside and an incredible price move within this particular market, which is a considerable move in a relatively short period of time. We're only talking about a few months within this price move. And then this market starts moving into a separate phase. And this one is consolidative. However, it's got a slightly sort of upward, as you can see, angle to this market. So what we're getting here is price action bouncing up and down within this level. So it's still consolidating. We're getting that sideways price action followed by some continued price action to the downside. So we start entering various different phases, even within different markets. So that's important to note as well. Okay, so I shall take that off. So going back to our presentation then, we've looked at some easy techniques to identify trending markets. We can use trend lines in a very simple and very, very straightforward way. And we'll look at entries and exits very shortly. And then we've looked at different phases which any particular market, in fact, all particular markets go through these different phases. So it is important to be aware of that. So what we'll do now is, because I do want to look at how a trader can utilize some of this information and use these indicators in a way in which you can enter and exit the markets with a degree of consistency. And also I'd like to address as well our approach to risk management. But before I do want to look at commonly used trending indicators. It's obviously there are questions we get asked an awful lot from a variety of different traders with various different experiences. So because this particular webinar is looking at trends, we shall address some of these trending indicators right now. Now, there is a fairly large number actually of free technical indicators that can help traders identify market trends. Now, I'd just like to very briefly look at each of them in turn. So the first one is a very, very common indicator. It's used by an awful lot of traders, and it's a moving average. Now, widely used as a lagging indicator, meaning that I'm going to take a chart now very shortly and I'm going to apply a moving average to it, meaning that it's always behind the current price. Now, it is actually based on past prices. It's not based on future prices or anything like that, or any projections going into the future. This averages out the price over a particular period of time. So to show you this, let's have a look and let's apply that market. Perhaps we'll zoom in on this market here, and we'll apply some of these indicators. So what we can do is on a MetaTrader 4, you can go up to indicators, scroll down to trend, because we are looking at trends. And as you can see, there's quite a few of them in there. Interesting to know the type of periods that you'd be applying. So what a moving average does, and there's different types of moving averages. So we will be producing a particular course on your ability to use moving averages in more detail. However, to just briefly explain, there is different types of moving averages, and they have slightly different characteristics to each of them. And what we're doing is we're adding up the price values of a number of different periods. And the reason why the word period is used is because each of these candlesticks represents a different period depending what time frame you're trading. And what this particular indicator will do is it will add up the price action of 21 periods. So in this example, this is a daily time frame, so we'll be looking at the most previous 21 price movements within each and every period. It'll add them all up together and divide them by 21, and it will give you an average price for this market. So we'll go ahead and we'll put this up on the screen. So this is what is posted, and if you can just hover over that particular market, you can see that the most recent value is 1.2373 in this particular market. You could also see it on the data window if I just bring it up just a fraction. So that is the most recent moving average. And this is just a simple moving average that we've used. So 2368, excuse me. So that all that value has done is added up the price action of the last 21 periods and because we're trading daily timeframes, that means 21 days, and it's divided that total by 21, and it'll give you an average. Now, currently, we can see that price is currently below that particular average. So the idea that traders use this particular indicator, depending on what setting they happen to be using, is that they'll be looking for opportunities to sell below the line, and they'll be looking for opportunities to buy above it. So it's nothing necessarily more complicated than that. Very easy to apply. I suppose the deciding what the parameters of your moving average is probably the most difficult, but you could apply that to every trading indicator out there. So it's quite as straightforward, and the reason why this helps and assists with trend identification is you can clearly see the upward movement of this market. So so that is a moving average. So the next one I'd like to have a look at is a parabolic SAR, and SAR just simply stands for stop and reverse. So this indicator now trails price as the trend extends over time. So for this one, I'd like to get back up, and I'd like to put up a parabolic SAR. And again, we just click on the relevant chart, and I'm going to overlay some of these indicators so you can see the information that it can begin to give you as a trader. So we'll go down to trends, and we'll click on parabolic SAR. So we're just going to work with the actual, I might change this color. So we're going to work with the parameters that are set for this particular parabolic SAR, and we'll put this in. So we've got our red, we've got a red moving average currently sitting in this market, and we also have a considerable number of dots both below the price and also above the particular price. So basically, if I zoom in a little bit more into this chart, you can see these little dots, and what these dots below the current price do for those that use a parabolic SAR is look for opportunities to support price. So if you're buying above these dots, then if you're applying this parabolic approach, and you can see that when price gets to this kind of level, all of a sudden you stop and reverse, and the indicator tells you that you should be looking to actually sell this market at that point, and that's how a parabolic SAR works. Now, if price is above, or if the dot, should I say, is below the current price, then you'd be looking for prices to be supported. However, if the dot is above, then you'll be looking for prices to be resisted against. So you're looking for opportunities to buy and sell above the dots or below the dots, and that's how traders can use parabolic SAR. Okay, so moving on then to the next one is a Bollinger Band. So this can be used to measure what's called the highness or the lowness of the price relative to previous trades using a band or a standard deviation. So for this, I'm going to show you the bands or the standard deviation. Again, I'm going to overlay this particular chart, let me see, we'll scroll down to trend. So we'll overlay this particular indicator up on the screen now. So we'll work with the parameters, the default parameters for this indicator. And you can clearly see, in fact, what I'm going to do is, so I just want to make this line a bit more prominent, just so we can see. So this is the bands, and I'll zoom out a little bit so you can see. I appreciate things are getting a little bit messy up on screen, but you can see the Bollinger Band. And plain and simply, and the reason why all of these support price is because you can clearly see that they all have the potential to confirm that you're actually in an uptrend for a variety of different reasons. So they all have pros and cons. This is our Bollinger Band. So we've got a deviation suggesting that prices are unlikely to push beyond these bands to the upside or to the downside. So it can give you plenty of scope to take some of these markets from the upper bands down to the lower bands and vice versa, from the lower bands to the upper bands. So a lot of these, they can assist with directional bias. You can clearly see that the trend of this market is clearly going in one direction, and that is up to the upside. However, we're doing so within the nature of a particular band which has been set. So that's how traders use it. So that is Bollinger Bands. So the last one I'd like to have a look at is Average Directional Movement Index. So this is an indicator which represents a group of movement indicators specifically designed to assist with direction. So let me get that up on screen then one more time. And again, I'm going to look to overlay this because I want you to effectively see how all of these indicators can effectively do the same job to varying degrees. And it's all about the application of these indicators as well. So what we'll do is we'll insert one more indicator, and it's a trend indicator. And we'll we'll click on Average Directional Movement Index. We'll work with the particular, we'll change it to a solid black, and we'll work with that. So this is a very, very interesting indicator. It has, if you can see underneath those levels here at the bottom, it has a multitude or a number, should I say, of directional averages. Let's say they use moving averages to varying degrees. And what I shall do to just show you that in a bit more detail is let's edit this one. So this is working with a 14-period average directional movement index. It also has a fixed maximum of 76, but you don't really need to know much about that to any great degree. So what this particularly, indicator does, if you can see it down here, and it's just the symbol for it is ADX, and it's a 14-period ADX. It determines when a price is trending strongly. So you can see these high readings on this market. Now, what that signifies to us is it indicates that this market is in a very, very strong trend at those times. And you can also see that the lower readings suggests that this trend is in a weaker trend, let's say. So we're talking about whether the trend is strong or whether it's weak. So if you're buying these markets, you're wanting to get in at these lower prices here, and then you're wanting to see your ADX or your average directional index, pushing to the upside, because this will signify that prices are pushing higher, and you are therefore in that trade to the right direction. So really, it's an indicator that can let you know when prices are trending strongly. Okay, so all of these different types of indicators have pros and cons. Now, visually, what we can do when we apply these things is you can see them all there. They're looking quite, they're all overlapped over each other. So I just let me zoom out just a little bit more. But effectively, they have variances in being able to, they can be used by traders to actually clarify your decision-making process to a varying degree of extent. And that's why a lot of these free, easy-to-use indicators are used by so many traders. But I would also like to argue as well that, you know, with just a very, very simple, straightforward line, you can indicate that this price is pushing higher. So that is worth considering. So it depends to the degree of complexity that you want to work with. Now, individually, these can all have significant impact in your ability to remain somewhat objective when you trade. You know, there is some positives to some of these indicators. However, there is some negatives to them as well. And you can actually trade markets technically without any of these indicators as well. It depends on your approach and your personality and what you like to do. So just please note that each of these indicators can potentially come with both positive and negative attributes, which you need to be aware of before using them. Okay, so to just finish off this practical part of this particular webinar, what I'd just like to look at is technical tools to assist with trade entry and exit, and also with an approach to risk. So for this particular section, I'm going to continue to use these charts with all of the technical tools which are currently laid down, and we can show you how you can approach a fairly simple and straightforward approach to trade entry and exit. So I'm going to zoom in to a particular sort of level on this chart. So let's work with this particular bit of price action in here. So if we're working with, so what we do is we've just put in a very, very simple blue trend line to the upside. So we're looking for potentially opportunities to get into this market at this level. So let's just say we wanted to work with that and the bands itself. We can see that the band is just sitting outside this ascending level. So how that can work with entry and exit is you can identify roughly this kind of area here. You might suggest that you might want to get in to this price. This is I tell you what, this is, no, let me change. Sorry, I'll change the color just to differentiate for you a little bit more. Let's say we identify what's called a bit of a structural failure, and we look to identify an entry price just around that particular level, expecting prices to push higher. What we can do is we can utilize this ascending line, and we can also utilize the lower Bollinger Band as two methods that we can use. We can see that the parabolic SAR can give you opportunities a little bit later to be very supportive of price. So we're taking all this in mind. We could apply a very simple, straightforward approach if we're just very patient and we wait for these opportunities to get a clearly defined entry, you know, based on a number of, we're actually inside the middle band as well. And we're just working with this. It's quite difficult to see, but there is a red moving average built in above this level. So actually our entry price at this level is actually quite significant. It has a lot of factors going for it. It's above the moving average. It's above the middle band of our Bollinger Band. So from an entry perspective, it's giving us a number of opportunities. Plus we're using technical analysis and our understanding of Japanese candlesticks to push this price higher. Now that's on the entry side, so you can use some of these to identify a trend, to be comfortable that you are looking to buy a primary trend, which is looking for opportunities to push this price higher. And what you also have is a clearly defined methodology that you can use for mitigating risk, and that is putting a particular, drawing a line in the sand in terms of your ability as a trader to make sure you don't commit more capital to this trade than what's necessary. So what you're risking is the difference between your entry and your stop loss. And if you're trading a trending market, then what you often have from a profit perspective is the potential to generate many multiples of your initial risk. So if prices move up to this particular price here, somewhere around this kind of level, then you're looking at a 3-to-1 positive risk reward in this trade. So that is just a fairly rough approach, and I do appreciate that I've currently left 4 different indicators on this chart, plus the ascending lower band of our trend line, which is more technical, to actually formulate an approach that we can use to apply these markets to the upside. So can you arrive at this situation just by looking at the charting patterns? The answer is, of course you can. And what I'm going to do now is I'm going to remove a lot of this information, and I'm going to start taking. So we just look at this price action in and around here. Sorry, I just moved it, I think, to December, and we'll take off some of these indicator lists. So to take these off, for those of you that are with the MetaTrader 4 platform, you can just highlight the right click on the chart, scroll down to indicator list, highlight the actual indicator itself, and delete it there, and you'll see all of these just beginning to come off, and the average directional movement index is the last one, and there you go. So still focusing on these, so you can certainly utilize some of those indicators, and it's all about giving you enough reasons to actually look to get into this trade. But you could take and make a lot of those decisions for the same reason, just based upon very, very basic understanding of a trend line. It's a line that's looking to push prices to the upside. So you're getting this bit of price action that's continually looking to drive prices higher. And if you look at this lower ascending line, you could literally just look for opportunities to buy markets at these lower ascending lines. And what you can do is you can clearly identify your entry, and you can clearly identify your stop loss, and you can hopefully you'll be applying a particular approach. That means that you'll be looking to have a positive risk reward on this trade if that happens to be your style and approach, and you'll get hopefully you'll be able to stack the odds in your favor in a very simple, straightforward way. But the point we're making is you can use a lot of those trending related indicators to actually effectively say the same thing, just in a variety of different ways. Okay, so that effectively concludes, and this is the approach to risk management, having a clearly defined area or price to actually place your stop loss, where you can calculate that risk accurately, and hopefully benefit from a good positive trade to the upside. Okay, so that just about concludes the practical element of this particular course. So as you can see, we covered a large number of topics, all to do with trends and how to identify them, how to define them, how to identify them, and hopefully how to get into them, and some trend indicators that can be used as well, with some basic understanding of technical analysis. Okay, so all that's left for me to do is to thank you very much for joining us. We do hope we will see you for the next installment very, very soon. So thank you for joining us. See you next time. Bye for now.